Right, good morning, everyone. Very nice to be here, and congratulations to Taxsutra for getting so many people here on a Saturday morning. Thanks to Vijay and Arun for inviting me, and also for taking a risk of having a session which is a little bit different from what you normally have in the Taxsutra sessions. So, I realize that we're running a bit behind schedule, so we'll try and ensure that we stick to the time allocated. We can see the counters moving already. But really what we hope to do today is, try and get some appreciation of the financial crime risks, business conduct, regulatory compliance, and what that means to tax and finance people in the room, whether you're working in, in-house tax or whether you're, consulting for corporates here or around the world. So this couldn't have actually come at a better time. This discussion couldn't have come at a better time because it was just yesterday that the FATF, concluded its plenary session in Paris, and no discussion in AML, CFT, or financial crime really, can happen without the mention of FATF. And one of the key points that happened yesterday was a couple of countries were actually removed from what is known as the grey list. So just a show of hands, how many of you know what this means, the high-risk jurisdictions and the monitored jurisdictions? Okay, how many of you have heard of FATF? How many saw the news today morning? Okay, so those of you who did watch TV definitely saw FATF being mentioned there. But for those of you who don't know, FATF really is the policy-making intergovernmental body which has laid out a set of 40 recommendations that countries and governments from all over the world have to follow to ensure that there's a tight AML CFT regime around the world. And what it does is, when you look at the high-risk section in this, you have Iran and North Korea, which are in that section. And those are really countries against which some countermeasures have been adopted from the AML CFT point of view. And then you have another section, which is the monitored jurisdictions, which is also known as the grey list. And if you look at in Asia, you see Pakistan being mentioned in the grey list. Sri Lanka was also there till yesterday, but that has been moved off the grey list now. And I think Pakistan just narrowly missed being put into the blacklist yesterday because of the support by China and Malaysia that it got. And it's been given time to the next plenary in February to either shape up or then it moves into the blacklist and joins Iran and North Korea. So why this is important to know and to set the background and context is that when you're dealing with these countries, you have to ensure that the corporates you work for or consult with are really following the rules when it comes to transactions touching any of these countries, or in case of trade, even any of the vessels carrying a flag with any of these countries. And if the country is actually on this, on the blacklist, it means that there are two things. One is correspondent banking relationships get affected adversely. So the country gets de-risked from money transfer point of view. It becomes very, very difficult to transact, and that's why trade gets affected. And the other thing is the money raising capability. So external borrowings, so whether it's IMF or World Bank, that becomes extremely difficult because they downgrade you, and so do the rating agencies. So the FATF actually has done a lot of work in the last few years to make sure that the overall regime has got strengthened. But coming closer to home, how many of you have heard of the Financial Intelligence Unit in India under the Ministry of Finance? By a show of hands, can I see some hands? All right, excellent. So for those of you, again, who don't know, the FIU is, it's a unit which is headed by a joint secretary level person. Typically, currently it's from the Indian Revenue Service, Pankaj Mishra, who heads that. And their job really is to be a sort of a service provider to the nation, where they collect reports from all the reporting entities, which are typically banks, mutual funds, insurance companies, casinos. Now lawyers, CAs are supposed to file certain reports, and analyze this information and then send the relevant information to either to intelligence agencies or the law enforcement agencies. So if you look at the bullet marked in yellow, which is the 1.43 million suspicious transactions which were submitted to the FIU in the year 2017-18. Of that, 65,022 were actually submitted by the FIU to law enforcement and to other agencies. These were unique 65,022 and around 73,000 totally, because one transaction would have gone to maybe multiple agencies. But as a direct result of that, the income tax was able to detect unaccounted income of up to 11,000 crores, and the ED was able to seize unaccounted assets worth almost 1,000 crores. Now, that's not to say that this is all that was seized or detected, but this is because of a direct result of the reports that were sent by the reporting entities to the FIU, which were then actioned and sent to the agencies. So why this is important for all of you from a tax perspective is because if you see the 65,000 reports that I mentioned which were submitted, almost 95% of them went to income tax. And these were reports submitted by banks or by FIs about corporates or individuals, maybe some of them who you work for or you consult with. So what we're going to try and speak today, Hala and me, is some of the risk areas that we feel are relevant and important from a tax and finance point of view. There are many other risks apart from these 5 which are mentioned here. So, sanctions, TBML, the straight-based money laundering, tax avoidance or evasion, concealment of beneficial ownership. These are all important matters for us to consider and appreciate from a tax and finance point of view. And if you look at the FATF or the APG, which is the Asia Pacific Group on Money Laundering, they have actually published a number of papers on these topics. And it would be great if, these are freely downloadable from their websites, but I think you should take a look at some of these because they actually have some very detailed cases on how corporates are moving money illegally. One special note about the one of the reports, which is the professional money laundering. This actually gained a lot of importance and was published after the Panama Papers because this is when you had Mossack Fonseca, which was the law firm who had a data breach, and it was found, that they opened shell accounts for thousands and thousands of their customers without doing proper due diligence. So if you're in the, I know there are a lot of lawyers in the room, a lot of CAs in the room, but I think a paper like this would be directly very, very relevant to you, and we'll speak about that, in a bit as well. So we're very honored to have Hala with us today. Really, she is the star of the show. My job was really to give a background to the discussion, which I hope I have done. And I'm going to spend the next 37 minutes in actually trying to get some insights from Hala. As you heard, she's a very, very accomplished person. You heard her intro just now. I had a chance to chat with her yesterday, and I think what she's achieved in the short 18 years that she's been working is actually tremendous. And there have been a lot of articles that she has, they've been widely published. She is an authority on various topics, right from slavery to artificial intelligence. And before I actually start the Q&A, let me hand it to Hala in case she would like to say a few words.
Thank you so much. Thank you, Shirish, for the great introduction. And thank you, Taxsutra. Thank you, Vijay. Thank you, Aaron. And thank you, everyone, for attending today. And I know it's your weekend, and we have full house. And just before we start, I want to thank Vijay a lot, and I want to wish you a happy birthday. Vijay's birthday was a few days ago. So thank you, and happy birthday. So before we start, to set the foundation of this panel, also, there's misunderstanding sometimes of the definition of financial crimes. So what is financial crimes? Before we go dig deeper, me and Shirish, on the concepts of financial crimes, we would love to ask you a question on your understanding of financial crimes, and then we kick it from there. So from your understanding, which one of the below can be a financial crime? You have the devices on the table. So it's human trafficking, modern slavery, child abuse. Is it bribery and corruption and fraud? Is it money laundering and terrorist financing, virtual assets, crypto crimes, market abuse, cyber crimes, 3, 4, and 5, or all of the above? That's awesome, actually. So we have 54.2% saying all of the above, 16.7% saying money laundering and terrorist financing, and 29.2% saying 3, 4, and 5. So the answer is all of the above. Can we please go to the slides? Yeah, the other. We have? Oh, okay, perfect. So what is the financial crime scope, and what's the definition of financial crimes? One of the things which people tend to explain, when you ask someone what's the definition of financial crimes, they tell you, when I commit something and out of this something I get illegal funds. So any action which gets me illegal funds. Well, the definition of financial crimes had widened in the past years, specifically also in 2019 with the developments, regulatory developments which happened across the globe, which Shirish mentioned lots of it. So the definition of financial crimes is not only doing the activity which gets you illegal funds, sometimes doing nothing. So sometimes the silence can create financial crimes. Sometimes facilitating something can get financial crimes. Sometimes supporting. And sometimes doing nothing, just watching a connection between two parties can create financial crimes. How does this translate in the below? In the following, sorry. So human trafficking and modern slavery. Some people say, like, why this is related to financial crimes. Sometimes when you have illegitimate funds out of human trafficking, when you have illegitimate funds out of modern slavery, when you have illegitimate funds from child labor, sometimes when you connect two agencies, you bring the laborers, connect them to agency in another country. Sometimes when you do the transportation, this is financial crimes. So sometimes you're not doing the activity itself, but sometimes you facilitate it. Bribery and corruption can happen in many ways. It doesn't need any explanation. Money laundering, all of you had consensus on money laundering. It's either in your 3 answers, you selected money laundering. So we're agreeing on that. Virtual assets and cryptocurrency, which we will talk about it more, it's also now a new type of financial crimes, and it's very interesting and dangerous one. Terrorist financing, also you all had consensus about that. Fraud, which can happen through documentation or can happen online fraud. And cybercrime, which some people think cybercrime is a side crime. It's not related to financial crime. Well, it's very related to financial crime, and we're going to talk about it also. Market abuse and market manipulation, it comes without saying. So those are some of the most important types of financial crimes. So we're going to kick off now the conversation, keeping in mind these types of financial crimes. Over to you, Shirish.
Right, thanks, Hala, for that. So, Hala, at the beginning, let's take a step back and, let me ask you, what do you think are some of the, let's say, global developments that have happened in the recent past, which are influencing some of the regulatory actions or guidelines and some of the enforcement actions as well? If you can throw some light on that.
Sure. Actually, this year was a very interesting year. We had more than 4 or 5 developments. We had the FATF, which is the Financial Action Task Force, which Shirish explained it in his slides. It's an intergovernmental body which creates policies. It's a policy maker. And you can call it like regulator of the regulators because it sets policies, it does mutual evaluations on the countries, and it has very strict criteria in order to accept the countries to become its member. There are like high standards for countries to be members. And as Shirish showed you, we have gray, black list, or some people, they are not on any list, so they are fine. So FATF had recent guidelines and amendments and added few things which are key highlights. Also, we're going to discuss it during the conversation. The key elements of that was highlighting virtual assets, financial crimes, cryptocurrency, which wasn't highlighted before. Also, there's guidelines for tax professionals, for accountants, for lawyers, which also we never had before. There's strict regulations for anti-money laundering and terrorist financing, and there is great imposement on risk-based approach. Another thing which also came, OECD also had recent amendments, and also money laundering when it comes to tax professionals. They set a draft guideline, and now it's also under assessment again, so this is also very relevant to yourselves. Also, we had the United Nations Office of Drug and Control. Also, it sets new regulations about money laundering and specifically terrorist financing. And we had, as well, several treaties when it comes to bribery and corruption, cybersecurity, and market abuse. And one of the things which actually caught my attention, there's the UK senior management regime, which is not related to financial crimes itself. However, it's related to the accountability of the senior management towards any compliance issue. So this is a regime which was set in 2016, amendment to 2017, and some amendments also came in 2018. Any company which has UK ties, or any UK company which is, for example, having a branch here in India, has to apply by these standards. And this means like there are certain criteria when you hire your senior management. Those senior management should know and be compliant and be accountable for any single compliance issue which happen within the company. This is actually great enforcement, which actually very positive, very optimistic. So that's for the brief. There's many, but those are the key highlights.
Sure, excellent. So, coming back to the risk areas that we spoke about, so what would you say are some of the major operational risks that corporates such as these are faced with? And if you could elaborate a bit on that.
Ken, actually, I would like to ask the audience a question, and then we kick it off. Please,
sure.
Can you pull out question 2? Are you concerned of any of the below risks within your companies? Deciding who is responsible for mitigating financial crimes risks. Lack of skills to mitigate financial crimes, lack of accountability and enforcement, knowing your customers and suppliers, third-party risks, not enough technology or AI, lack of clear policies and procedures, knowing if you are internationally compliant as well. Are any of those a concern? Please vote. The devices are on the table. Wow, that's very interesting. So the majority, 22% says lack of clear policies and procedures. Then 16% we had deciding who's responsible to mitigate financial crimes, and lack of accountability and enforcement, which is very similar. 12% knowing your customers and suppliers, 10% lack of skills, and not enough technology or AI. Well, all these are operational risks which your companies will be exposed to. Specifically, after the recent developments in 2019, we listed 5, but there are also many, but the 5 keys which impacts you directly. All of these are concerns. So one of the things which you need to decide now, specifically in your professions, is who is accountable. And we have this perception, for example, let me just say tax professionals. There's this perception that they are not, and it's true, this came by the years. They were not involved in financial crimes or compliance. It is a side corporate business or profession, which usually is not integrated with financial crimes. Well, after these developments, they are. Lack of skills to mitigate financial crimes, also this is something which needs to be picked up, because now there's no one above compliance and financial crimes. As you could see, Financial Action Task Force, United Nations, European Commission, all of them impose that it's everyone's duty. There's no separations between professions. Knowing your customers and suppliers, ultimate beneficial owners, also is a key operational risk, because we have many cases where the financial crimes happen because we lost track on the real ultimate beneficial owner and complex structure. Third-party risk, the crimes which we showed at the beginning, many of them, specifically when it comes to human trafficking, child labor, child abuse, etc., all these crimes, many of the third parties which you might be dealing with are associated with that. Knowing your suppliers is as important as knowing your customers. Knowing your customer's customer is as important as your customers. Knowing your customer's business is as important as knowing your customer. So it's widened a lot. Not enough technology, artificial intelligence, to support the mitigation. In many of the cases, we lag behind to mitigate financial crimes because we do it manually. We screen our customers or our suppliers or customers' customers or transactions manually. This is impossible. If you have like 10 clients, we're fine. But when it gets more than that, you need to have technology supporting you. Lack of clear policies and procedures, definitely, specifically from the professions you come from. We have the classical, traditional one for like compliance officers, which me and Shirish, we work a lot with these industries. We tend to find it very rare to have policies and procedures when it comes to legal firms or when it comes to tax professional firms. Knowing if you are internationally compliant with all these development, and if you want to have international exposure and expand your business and bring in business and mutual investments, definitely you have to abide by international compliance standards. So all of these are operational risk. Definitely there's much more, but those are the ones which you need to focus on.
Right, thanks, Hala. So, Hala, of all these, let's focus on maybe 2 or 3 which would be very relevant to the folks in this room, and one of them is trade-based money laundering, right? And trade-based money laundering has been acknowledged, I think, by regulators around the world and also by customs authorities of being one of the mechanisms where a lot of money is moved illegally across borders, and I think it contributes to almost 80–85% of the actual laundering which is happening. So, what would your advice be to the corporates in this room on how they should not be knowingly or unknowingly partners in crime here?
Thank you, and that's actually an excellent point. Trade-based money laundering wasn't of that importance before 2015. 2015, several crimes happened where it involved export-import trade-based money laundering, and then regulatory enforcement came to force regarding that. Before also we start, let's kick off question number 3. What elements of the below do you think corporates is exposed to when it comes to trade-based money laundering? Knowing your customers and their customer, letter of credit, letter of guarantee, knowing the goods, over and under invoicing of goods and services, multiple invoicing of goods and services, overshipments of goods and services, falsely described goods and services, and detecting dual-used goods. Just for your info, dual-used goods are any goods which are used for chemical manufacturing. Sometimes it's used for medication, but as well it's used for weapon manufacturing, so it has both sides. And sometimes it's used for weapons of mass destruction, nuclear bombs. So this is dual-used goods. So please, let's vote. Knowing your customers and their customers and knowing the goods. And over and invoicing of goods. That's actually excellent. I'm happy to see that the results is question 1. The answer is all of them, definitely, but the most important, in order to get to 2 and 3 and 4 and 5, you have to satisfy 1. As we mentioned, knowing the customers and knowing the customer's customers is as equally important as knowing the customers. Knowing who is the lender, who is the originator, who is the receiver, who is the beneficial owner, what kind of goods, knowing also, which actually it's fascinating, detecting the discrepancy between the goods which are shipped and the line of business of the sender or the receiver. Like I worked on a case where someone the industry was water industry, like creating bottles of water, and the shipment was all the time clothing, which was over-invoiced, and sometimes the pricing doesn't make sense. So this is very important to detect the discrepancy of line of business versus the sender and the receiver. Another thing also to detect is the shipment route, which sometimes we tend to forget. We sometimes say, like, why do I need to know about the shipment route? This is red flag sometimes, because shipment route sometimes might be between India and Europe. Why you're stopping in Iran? Why every time you're stopping there? So also this is sometimes something to detect. Sometimes also, which I worked on a case personally, the sender and the receiver and the ship owner are of the same company, ultimate beneficial owner. So it's a complex ownership. The sender, the receiver, ship owner are the same, but under different names. This is also creates red flags because there's influence here on the things which are shipped. It's very important also to detect the invoicing. For example, as tax professionals, the invoicing, do they make sense? Are they relevant to the person who's sending or receiving, to his regular transaction, to his background, to his business? Why it's invoiced? Why he's dealing with these types of industries, while in reality he works on something else. And dual-use goods, as we mentioned, whenever there's something related to dual-use goods, it's a very, very high risk because it might be associated with nuclear bombs or mass destructive weapons. Thank you.
Thanks, Hala. So one of the things that you just mentioned in context of TBML is the beneficial ownership angle, right? And we have, as I said, a lot of lawyers and CAs in this room, and whenever a company really wants to conceal the ownership, it employs the services of lawyers, chartered accountants, consultants, to really see how complex it can make the holding structure. So what is your advice again to this group here on the area of UBO? And also if you can bring in a bit about the Panama Papers here, why did the whole professional money laundering report get published by FATF? That would be great.
Sure. Can we also pull out question 4 before we kick it off? Are you concerned about any of the below? Complex structured ownership of your customers. Complex structured ownership of your intermediaries, suppliers, supply chain partners. Defining ultimate beneficial owners manually rather than using technology and AI. Lack of enough skills and awareness at your company to detect ultimate beneficial ownership. UBO. Let's vote, please.
So just as you're voting, I think one of the things which is also important to remember now that just UBO is not enough anymore. What most people are tracking is something called SBO, which is significant beneficial ownership, right? Because you may not be the ultimate owner, but you could also be a significant owner influencing the ultimate owner.
Lack of enough skills and awareness at your company. Wow. And number 3, 20%, we have defining ultimate beneficial owners manually rather than using technology and AI. Actually, 3 and 4 can be merged because, as we mentioned in the beginning, detecting your customers alone, doing it manually is not enough. So definitely, it should be associated with technology and some AI, depending on the size of your business. So this is something which everyone should consider. As for the importance of ultimate beneficial owners, this is a very crucial element because sometimes the people who we see or deal with or sign with are not in reality the real beneficiaries of the transactions or the account or the business we're dealing with. And this is very crucial and sensitive because sometimes everything clear is in the first layer when we deal with our clients. However, in reality, those people are associated with the bigger mafias or bigger complex structure, which imposes us to higher risks. So just to give you an example on a case I worked on, so we had, initially, we had a tip-off from a tax professional company. So this is very relevant to you. A tax professional company tipped us off that one of their clients, and they asked us to keep their name confidential. One of their clients actually, and this tax professional is also associated with India, one of their clients, when they are doing their tax advice and calculations and all of that, they found discrepancies between the companies they have, the income they have, the invoicing, so there was kind of discrepancy. So they tip off the investigation unit, and at that time I was advisor to that. So we were working on the case to detect what happened really. In order to like go step by step to understand whom we're dealing with, who's the ultimate beneficial owners, we went to the account and we checked the documentations and the legal documentations. Everything seems clear. We have right trade license, right board resolution, right shareholders management document. Everything was in place. Even the business, the accountants, everything, financial statements seemed fantastic. So we called the company. We didn't say definitely that we are investigating. You cannot tip off your clients. But we associated with their bank, and we said, we're coming to owe you a visit, because whenever you have big accounts, it's good to visit them, right, to visit their premises. We went and visited them, and I remember at that time that we went from the elevator, we went to the left, it's in the 3rd floor, and it's a very busy floor. People are working, some people on the phone, some people on the computers. So it's a busy, real company. It looks very real. Nothing to feel it's fake or nothing at all. It looks fantastic. So we had these doubts, like we have all the documentations, transactions seem legitimate. The company, when you go there, seems very real. So what's the problem here? Before we were leaving, one of us detected that the furniture in the company was the legs of the tables and the chairs were wrapped with nylon wraps, with plastic, which just made us think like why it looks that new furniture while the company is there since 3 years. So we had a chat with one of the secretaries, and she slipped and she said, this is a furniture shop, very nice furniture. We bring our furniture from them. We called the furniture shop. They told us that the furniture arrived that morning. So this floor had nothing. There was no business, no company, nothing. When we called them and told them we're coming to visit you, it was furnished amazing. So, however, we cannot go to the jury and say, hey, the furniture came today, that's why we're suspicious. We had to go again without telling them. So we waited for 10 days and went and visited them without informing them. It was an empty floor. There was bugs there only, so nothing was there. And then the investigation started. This is a tip off from a tax professional. We realized the ultimate beneficial owner of this company is a mafia of drugs dealing with Ukraine and Russia. The shell company, the main company which we were dealing with as if we're facing, amazing company dealing with textile and everything which is low risk. So that's why the slip in the bank, when we told the bank you didn't do your diligence on that, when they didn't do complete diligence on ultimate beneficial owner, they only did the diligence of the person who came to them and signed. So that's what the example I'm telling you is sometimes it's not what you see. Sometimes there's behind what you see a huge, huge complex structure. So this is, and this company was associated, they had lawyers, they had accountants, and tax professionals. So everyone can be exposed to that. So I hope I summarized that with the case.
Yes, absolutely. In fact, I think that point number 4 is very good for you because you can plan a trip to Delhi and do some training on UBO skills. You can do a training on UBO skills and come back to Delhi and run a training program.
Yes,
here.
absolutely.
Yeah.
Absolutely. I would love that.
So we have a few minutes left. I'd like to keep 5 minutes at the end so that everyone can interact with you. So in the next 5 or 6 minutes, let's just quickly speak a bit about crypto, because I think that's one of the other areas which was a bit ambiguous, was, everyone feels that there is some money laundering happening through it. So I'd like you to really, tell everyone, what is the truth? Is there some money laundering or financial crime happening through virtual currencies or through crypto? Or is that just a myth?
Sure, thank you. So crypto definitely, these days, cryptocurrency, Bitcoin, or what we call it virtual assets, vast virtual asset service providers, all these terminology which you will hear, and many other currencies, but crypto is the most famous one. And these days, there's more importance than ever because Financial Action Task Force and OECD clearly now had guidelines about crypto. So crypto are no longer excluded from anti-money laundering and mitigation of financial crimes, which every institution should have. So it's part of the system now. One of the things which every government should do now, it should embed it in their regulations. So enforcement is key here. And still many crimes, financial crimes, are happening through crypto because there's lack of enforcement unfortunately. And maybe we will see very, very soon some amendments, some additions, some new regulations because of FATF, Financial Action Task Force, and OECD. Crypto, as mentioned, is high risk. So every time there is a dealing with virtual assets, it's automatically a high risk dealing, automatically. And as FATF mentioned clearly, everyone should be approaching any client or business through risk-based approach, categorizing your clients. So first thing we agree on, crypto is a high risk. Crypto can be associated in money laundering in the 3 levels of money laundering. Money laundering is placement, layering, integration. Placement is when you do the crime, you get the money, rather than putting it in a bank and the bank asking you what's the source of wealth, you start smurfing it into small things in order to lose track. One of the and this is called placement. You start placing it in the system. Now, a new trend of placement is through cryptocurrency. You start placing those money in cryptocurrency. So placement, and then you start layering. Layering means transferring. Transferring to other exchangers, to other crypto dealers, to other beneficiaries, you start just manipulating the system. And integration, you start buying with it things, and sometimes at the end exchanging it with cash. So with the 3 layers of money laundering, crypto can be used. It's very, very attractive to criminals because there's anonymous identity most of the time. In addition to anonymous identity, it's very easy to evade taxes because who can track you? Sometimes, especially when you're dealing beyond the territory you're in. Cryptocurrency is very similar to cyber crimes because they are extraterritorial in nature. And it's a silenced crime. You cannot track it. You cannot track sometimes the originator, the beneficial, the exchange. You cannot track when you deal with crypto to buy things from the dark web. So it's very attractive to tax evaders. It's very attractive to money laundering. And recently, there was a huge crime supporting terrorist financing crime, supporting ISIS. It was through crypto. And some South Asian companies were involved. Russia was involved, Iran was involved, and 3 countries in the Middle East as well. It's all through cryptocurrency. So the end user, the end beneficial of this layering and integration of cryptocurrency, Bitcoin, was to finance terrorism, to finance ISIS. So yes, it is very, very risky.
Right. So Hala, given all these risks, and problems that we see in this area of financial crime, and given that it's been mainly regulators who are coming out with certain measures, could you also speak a bit about maybe some public-private partnerships which you've seen maybe in recent times, which are helping in the fight against financial crimes?
Sure. Thank you. So PPP means public-private partnerships. And in many of the financial crimes, public-private partnerships really benefited a lot mitigation of financial crimes. We see it a lot in money laundering. We see it a lot in cybersecurity. We see it a lot in terrorist financing. However, there were certain attempts. It was the life of the PPP wasn't that long, for many flaws or non-alignments or disagreements. One of the PPPs which really interest me, and I'm very impressed when I follow them, I follow what they are doing. They started in 2016, kicked it off 2017, is Fintel. Fintel is an Australian initiative, public-private partnership. It started with the AUSTRAC, and AUSTRAC is the Research Center of Analytics when it comes to mitigating money laundering and terrorist financing. So AUSTRAC came with an initiative in order to bring 25 parties from private and public sector. And the beauty of it, it wasn't only local, it was local and international. And amazing, I was reading the other day, watching on the news about what does a day at Fintel looks like. How the report comes to AUSTRAC, for example, there is certain suspicious red flag from certain institution. And they can't decide if it's a crime or not, it's just a red flag. How they sit together, the FIU, and they sit together, the banks, corporates, and international corporates, international regulations under one center, one roof in Australia. And they check if this client is also your client, your client, your client. they bring together this transparency, which sometimes we don't have access to other banks, what other banks do. I don't have access to corporates. I don't have access to companies beyond India if I'm working in India. There's transparency, there's confidentiality, but OSTRAC broke all these rules and brought together this. It's amazing. It's very efficient in terms of time. It brings the countries together. It helps in evidence and investigation. And the turnaround is fantastic. So after Fintel came on board, the mitigation of financial crimes actually increased by 40%, which is amazing in 2 years. Yeah.
Great, thanks. That's a great example. So to wrap up, Hala, what would you say are some of the action items that this audience should follow when it comes to fighting financial crime in their own sphere of life? Is it skills? Is it training? Is it something else?
Thank you. So for many of you here, for many of the backgrounds, knowing yesterday and from the panelists and the speakers, I know sometimes financial crimes might be new to you, and it's not relevant, and it's not something you're associated with on a daily basis. However, due to recent developments, you are now part of the system. And what applies to financial institutions and compliance officers, anti-money laundering officers, traditional corporates and banks now applies to tax professionals, accountants, law firms. My advice to you, first step, upgrade your knowledge. Attend trainings. Training and awareness is the key element. So it's the basics. Start with that. Second, do a risk-based approach whenever you having any client on board, whether country of origin, whether nationality, whether line of business, whether transactions, whether pricing, all of that should be all together in front of you. It should be documented. Risk-based approach is very crucial, especially now. Definitely India and many other regulators should adopt Financial Action Task Force and OECD when it comes to your professions, should be embedded in the enforcement measures. So when there's supervision, you will also be supervised and audited when it comes to the measures you take in mitigating financial crimes. So please have a very, very high risk-based approach. This is my advice to you, direct advice. And as mentioned, training, awareness, knowing more your customers, beyond expand the introductory measures to do your customers KYC, KYCC, customer, KYB, know your business, KYT, know your transactions, KYLB, line of business, correspondent bankings, your clients, suppliers is very important. So all this should come together. I know it's extra work for you, but it mitigates lots of crime with your help. As mentioned, I had many cases where the tip-off comes from your professions, which helped us mitigate crimes a lot.
Thank you so much, Hala. It was a wonderful conversation, and I think we have 2.5 minutes left, so no, we don't. So not even one question? All right, okay. We'll take questions later, and Hala's around for the next couple of hours, so you can meet her. So thank you very much for being a patient audience. Thanks to Taxsutra for allowing us to speak.